Hi, this is Patrick Adams with This Week's Market in a Minute, and the theme this week is there's a clear message from the bond market to the Federal Reserve. Back off now. So we're going to go over that in detail. First, some highlights on the overall market. The market summary. The S&P 500, currently the PE is below 18 times earnings for 23, and next year roughly 15 and a half times. That's kind of interesting at 15 and a half times. That kind of gets me interested. There's some attractive stocks, but the earnings need to quit going down. Earnings, we think, are at risk for another maybe 10% this year and next year, provided that the economy goes into a recession. And if it doesn't, then stocks are pretty attractively valued. We believe the Federal Reserve should stop. There is a clear message from the banking system, the bond market. It needs to stop. It was too aggressive too quickly. Now they were behind the curve for a long time, and they got caught up and they broke something. The federal funds rate is currently 4.6%. The federal fund rate usually tracks the 2-year Treasury. The 2-year Treasury on March 8th was 5.1%, currently 3.9. The 10-year Treasury at 3.5. This is good. It supports a PE multiple of roughly 18 times. So many of the inflationary pressures are easing. In particular, the one thing that really bothered us a lot was oil prices. Oil prices were as high as $120 a barrel. Now they're 67. That's going to have a big impact on inflation, and it'll filter through a lot of the goods that we buy as the year goes along. The investor sentiment, very negative. 2.5 times bears the bulls. This is so negative, it's becoming a positive. Geopolitical risk is high. Russia and China don't like them teaming up together. If China supplies Russia with military gear, it's not going to be a good thing for the overall global economy. Political risk. We live in such a strange political environment in this country currently. The Biden budget that was sent over was just lacked total seriousness. So they're economically thinking about the political risk. There is a possibility that the government will shut down come June. There's a lot of negotiation that needs to be happening between now and then. Now, the Federal Reserve meeting on Wednesday. This is the 2-year Treasury note. The 2-year Treasury was up at 5.1% on March 8th, has corrected all the way down here to 3.9. So the bond market tracks the federal funds rate, or the federal funds rate, I should say, tracks the 2-year Treasury very closely. It is now currently a 70 basis point difference between the two. That's way too high, doesn't make any sense. So the message from the bond market to the Federal Reserve is you better stop. The economy needs the banking system. If the federal fund continues, we're going to see more defaults in the banking system. It needs to stop. So at least pause and see how this plays out. If we do get a pause, there's a very meaningful rally to occur in the stock market. So looking at the banks a little bit closer, generally this doesn't happen. You don't get a spike in rates the way we have over the last 12 months. It's never happened before. You've never blown up the assets on the bank's balance sheet the way we've done it. You don't have these enormous losses in the treasuries that they own. Usually the banks have problems because they make really crappy loans, right? So this is Federal Reserve induced, this banking crisis. However, a lot of quality banks have come down a big way. This is Fifth Third. Fifth Third was $50 a share just over a year ago. Now it's half that, roughly. So we love good quality stocks when they get cut in half. So this is an opportunity. Stock trades at 6.5 times expected earnings. We know those earnings are wrong, but 6.5 times, that's just too low. And the stock yields 5.3%. We like Fifth Third. It's probably one that we can buy here, and we did last week. So what's going on internally in the stock market? Well, you see this big divergence between the Dow Jones and the NASDAQ. The Dow off roughly 4%, the NASDAQ up 11. That's a 15% divergence. There's a clear message by the stock market as well to the Federal Reserve. The stock market's getting defensive. It's very concerned about what the Fed's doing, the impact on the banks. Gold's going up. You can see it's up 8% year to date. Treasuries are going up in value, down in yield. Mortgage REITs are diverging. So people are perhaps selling their mortgage REITs and buying long bonds. However, we think this is overdone. Our favorite stock here is Dynex, DX, 12% dividend yield. The tech stocks, as we mentioned, the NASDAQ, tech stocks are up 15% year to date. That's not sustainable. But as you know, the mega cap technology companies have lots of cash, so they're looking defensive. Healthcare down almost 8. That makes no sense. These are quality companies. They benefit from a lower dollar. The dollar's been creeping lower. This sector of the market is very interesting. Financials off 10. Of course, that underestimates or underreports what's been going on in the banking area. Banks are off 32. The total financial area off 10. Lots of interesting things to look at in the financials as we get more confidence of what the Federal Reserve policy is. Energy down 13 year to date. That's a flight to out of cyclical companies. And you can see that also occurring in materials and real estate. So generally speaking, what's going on is the stock market is getting much more defensive. It's anticipating things getting worse. How to play this is, I think the Fed's going to pause, and likely a nice knee-jerk reaction to the Fed pausing, and we could creep back up to the recent highs of roughly 4,200 on the S&P 500. That's a nice move, and maybe it drifts a little bit higher than that. We like the healthcare space right now in particular. Some of the bank stocks are very undervalued, and we're looking for a point to increase our exposure there if it makes sense to do so. Now, our favorite stock in the healthcare space, because it is so defensive, very predictable, they're not going to miss a lick in terms of their earnings or revenues. The dollar coming down helps them quite a bit. 14 times earnings, the stock usually trades at a premium to the market or in line with the market. As we mentioned, the market's PE is close to 18 times, so there's room for the multiple to expand. It's off 15% from its high at the beginning of the year to where it is currently. That's a major decline for J&J. Great balance sheet, so this is one that you can feel comfortable putting some money into. Thank you very much. Please hit like, hit subscribe. If you want a hard copy of Mark in a Minute, go to my website, Patrick Adams CFA, and we will send you the weekly research piece that we do. Thank you very much. Take care.